Hey, welcome to the video. In this video we're going to talk about the balance sheet in a bit more detail following my video on financial statements, which gave a brief overview of each one. This is going to be the fourth episode, third in our accountancy basics. If you like the video, please give it a like, subscribe, and yeah, so without further ado, let's get into it. So in this video we're going to cover the balance sheet in a lot of detail. We're going to cover why it's needed, what it looks like, how cloud accounting is making life so much easier for us accountants. I thought it'd be worth mentioning that there's another YouTuber who's doing, well, he was doing it first, but I'm doing my own take on quite a lot of the topics that he's also covered. I'm going to link his channel down below. I think it'd be really good if you check out some of his videos as well, just because he gives examples and I've made sure that I've used different examples so that you guys can just use as much of the resources as you can online for free and get a better understanding of accountancy. I'm going to try and do this for any videos that he's also covered that I'm covering, so be sure to just have a look around both of our channels, and if there's anything that you'd like covering, then please let me know and I'll make sure that I cover it. So a balance sheet generally is defined as a snapshot of a business's assets, liabilities and equities at a given point in time. So what this means is there's all of the balances roll forward depending on the period you're looking at. They never go down to zero at the start of each new period, unlike the profit and loss. This is because assets and liabilities aren't dictated by the accounting period and just are what they are at any given point in time. However, it's worth noting that a profit and loss is a sum of expenses and income for a given period, and it always goes back to zero at the end of the accounting year. So why is it needed? I also spoke about the reasons why it's needed in my financial statements explained video, which I'm going to link in the description below, and I'm going to also link it up in the top right of your screen. But the key ones to understand are: the balance sheet gives the reader a key understanding of how the business is performing and the overall health of the business. So if assets are greater than liabilities, then generally it's in a fairly healthy position, because if you were to liquidate, i.e. sell your assets, you could cover all of the liabilities, you wouldn't owe anyone money. Whereas on the flip side, if you have more liabilities than assets, then that's generally seen as a bad thing, because you can't cover your financial obligations if you were to sell your assets. There are obviously some exceptions to this, because quite a lot of businesses opt to fund their business through loans, which obviously shows as a liability, but this is not something I'm going to go into detail about. And if you're starting out in accountancy, just know that you want your assets to be greater than liabilities ideally. In addition to understanding the business performance, you also need to understand how to prepare a balance sheet, because you're going to need to prepare one if you're looking for investment or to secure a bank loan. This links to my first point on how it assesses the business's health, because this is what lenders and investors will look at to determine whether the company is a good investment or not. So I'm now going to put on the screen an example of balance sheet. This is one that I included in my financial statements video, so if you've watched that video then this is going to look very familiar for you. I'm going to run through each of these items, i.e. assets, liabilities and equity, just so that you are familiar with what we're talking about. But I did speak about them in quite detail and broke down each of the definitions in my debits and credits video, which I'm also going to link in the description and in the corner. So in a nutshell, assets are things that you use to generate money for the business. So examples of assets are accounts receivable or sales invoices that haven't been paid yet. This is an asset because it signifies money that is going to be coming into the business. Cash is also an asset because it's something that you can purchase with. And also inventory is an asset because once you sell inventory, that will generate you income. So liabilities are also So liabilities are essentially the opposite of assets. So where assets are items that generate the business money, liabilities are obligations that will result in money being paid out from the business. Finally, equity is essentially made up of quite a few things. Retained earnings, which can be made up of a number of things. It's mainly the sum of all of the profits for prior years. It's quite common to also include the current year's profits in there, but I like to have a separate separate line for profit for the year so that you can easily see the profits that have been brought forward that can be used by the business as internal funding, and get a profit figure for the year by just looking at the balance sheet and not needing to look at the profit and loss. So I'm now going to go through each of the items that are under the assets, liabilities and equity section in my mock balance sheet, just so you can get an understanding as to what they are. So under the current assets, we've got cash, accounts receivable and inventory. I've just discussed these, so I won't go over these again, but they generate income for the business, so that's why they're assets. Fixed assets is equipment that you use, usually over a long period of time, that also generates money for the business. This can be property, plant and equipment, land and buildings, and fixtures and fittings. Usually, unlike short-term assets like inventory, fixed assets are long-term assets, and so they are also depreciated, which explains the accumulated depreciation showing underneath the asset line. This is done so that the balance sheet has an accurate figure of the real value of the fixed assets. In order to determine what's a fixed asset and what's inventory, usually there's something called a capitalization threshold. If you capitalize something, you make it a fixed asset. If you don't capitalize it, then it goes into your inventory or goes into the P&L as an expense. Depending on the size of your business, you may choose to have a lower capitalization threshold than some other businesses. Generally, if you're paying out a lot of money in the millions, your capitalization threshold for what you would capitalize as a fixed asset would be a lot higher than if you were a t-shirt business that's just buying a print press for £500. So moving on to the current liabilities, we've got accounts payable. There can also be PAYE liabilities and VAT liabilities, but I'm going to cover these different liabilities in a payroll and VAT video that I'm going to do in the future. Accounts payable is a current liability because it's invoices that haven't been paid that will need to be paid in the future. This is a current obligation which will result in cash coming out of the business's bank account and therefore meets the definition of a liability. In a limited company, there's always going to be share capital. It can either be paid or unpaid, but either way, it's what is needed in order to incorporate a business. As you've probably seen, shares are openly traded on the stock market for public listed companies, but the difference between a public listed company, a PLC, and a private limited company, a limited or an LTD, are that private limited company shares aren't openly sold on a market and can only be bought or sold if agreed by both parties under very specific arrangements. This is something called private equity, but for the purposes of this video, just know that share capital is what you would put in to incorporate the business and represents the share value that you own. If you want me to do another video on shares and share capital, then let me know. It can be a bit confusing, but really it's just something that you need to... Every limited company needs at least one share in it in order to be a shareholder, and you can assign any value to that you want when you start the business. Typically people choose £1, £10 or £100 as the share capital, but it can go in thousands if you really want to. We've also covered retained earnings and profit for the year, so I won't talk about these again. And you'll notice that the total assets and the total liabilities plus equity are equal to each other. This is obviously an indication that our accounting equation is balanced and there are no issues. I wanted to take this opportunity to also mention about cloud accounting and how it's really helpful for balancing these sorts of reports, because the software understands double entry bookkeeping. Whenever you post something in the system, it will automatically do the double entry for you. So if you raise a bill and you put in that you want it to relate to a certain expense, it will automatically debit the expense and credit the accounts payable without you needing to do anything. Then you can simply run the balance sheet report and it will have already reconciled and it will already balance for you. So now let's take a look at some examples and show how they are going to be affecting the balance sheet. So as you can see, I've reformatted our balance sheet into the accounts we'll need to go through these examples. So I'm now going to show you the examples that we're going to run through on the screen now. So example 1 is we buy 100 t-shirts for £2 each. We're giving an invoice for 30 days that we can pay on credit. So as this invoice isn't going to be paid immediately, it won't touch our cash. However, it is going to be a current liability, and when we post this bill into our accounting system, it will show in our accounts payable. So our credit entry is going to be £200 because £2 each and 100 t-shirts is £200, and it's going to be an accounts payable item, so we're going to credit accounts payable for £200. Now as you can see, our total liabilities is 200 and therefore our total equity and liabilities is 200. However, our total assets is 0, but we need to recognise £200 worth of inventory as we've just received £200 worth of t-shirts. So we'll put that in our inventory line. Now you can see that our total assets and equity and liabilities match. For example 2, we pay labour £200 to repackage the t-shirts for shipping, and we pay these in cash. So it's really important to note that our profit for the year is our link between our profit and loss and our balance sheet. So although the labour cost is going to go down as an expense, which will be our debit, it's really important to understand that this will go into our profit for the year under equity, as well as hit our profit and loss, as these are two separate statements. So we're going to put in £200 into our profit for the year, and it's going to come out of our cash as a credit because we're reducing our assets because we've just paid labour. As it's an expense, our profit for the year is going to be a negative because we currently don't have any income recorded. So that's why you're seeing a profit for the year as a negative 200 and a current asset of negative 200 for cash, because the asset for cash was 0 and then we've credited it for the £200 we've paid. So now we're in an overdraft of 200, which is a negative asset. Ideally, an overdraft should go on the current liabilities section, but for purposes of this exercise, it's easier if we just keep them in the same place for now. So in our first example, we had an invoice that we were going to pay on our 30-day credit terms. We've now decided that we're going to pay this. So we want to reduce our cash by the amount of the invoice, and we need to reduce our accounts payable because there's no longer going to be the bill outstanding. So to do this, we're going to have to debit accounts payable. Now on the balance sheet, as it's under a current liability, which are all credit balances, if we then debit accounts payable, this is the same as reducing it. So this will now be 0. We've then reduced cash by 200 because we've paid the invoice. So if we reduce cash by 200, you can see we're now in an overdraft of £400. But you can see our total assets of negative 200 and our total equity and liabilities of negative 200 match. So we know that our accounting equation is in balance. We then get a bank loan to fund more t-shirts. This bank loan is £2,000. So the bank loan we're going to show as a non-current liability because £200 is owed back to the bank. So we're going to credit our bank loan by £2,000. As it's a loan, we're going to receive that cash into our cash account. So we're then going to debit our cash because the credit was a non-current liability. Our debit is going to be cash. So now we've got 1,800 in the total assets and we've got 1,800 in total equity and liabilities. So we're confident that this matches. Finally, we sell 50 t-shirts to a shop, we invoice them and give them 30 days credit. Now this one's a bit more complicated because we need to recognise the movement in inventory as well. So what we would do is we would need to recognise the first entry as the invoice you've issued. So if we've invoiced them for £1,000 for these 50, actually they're getting ripped off. If we invoiced them £200 for these t-shirts, we would recognise income of 200 as a credit, and we would, because they're paying on 30 days credit, we're not going to be recognising the cash. Instead, we're going to recognise it as accounts receivable. So we're going to recognise £200 in our accounts receivable as our debit, and then our credit is going to go to profits of the year because it's income. So this now gives us a profit for the year of 0 because we've got our £200 expense and labour that we've already recognised in profit for the year, and now we've got income that's essentially just offset this to 0. But now, because we've sold 50 t-shirts, which is half of our inventory, we now need to recognise the movement in inventory. So what we need to do is, because we sold half our stock, we need to get rid of half of our inventory, which in this case is £100. So we credit our inventory by £100, and then we need to debit our profit for the year because it now needs to be recognised as a cost of sale in the profit and loss. So we need to debit our profit and loss. The reason this is a negative is because equity is credit as it's the capital element of dead click. So when we are crediting profit for the year, we would add the number, and when we are debiting profit for the year, we are reducing that number. And as we've debited our profit for the year, because it's an expense, we need to reduce the balance in profit of the year. And as you can see, our total assets and our total equity plus liabilities is equal. So hopefully that gives you a good understanding of the balance sheet. If I've missed anything or you need any clarification, anything, just drop me a message in the comments below and I'll be sure to get back to you as soon as possible. If you enjoyed that video, please like, subscribe, and I'll see you on the next one.